So the title speaks for itself in terms of you're gonna have some risk, whether it be from a company point of view or a financial investment point of view. And the idea is to, mitigate that risk somehow. So I'm going to show you the conventional way in which we can use other assets to, we combat losing out on risk. So we'll get to what derivatives mean eventually, and we will just get to what hedging means in a couple of slides. So how the presentation is laid out is you're going to start off with a couple of definitions, a few slides initially introducing the idea of risk, introducing the idea of hedging, and then derivatives. And then what we will do is I just thought I'd go into a little bit more in depth into one of the most popular derivative assets and show you the mechanism behind it. And then finally, I will end with uh, I think there's three basic hedging strategies that you can use it for. So that being said, let's get started. Oh, and I threw in some equations at the end to lighten the mood after, because up until then it'll be just a few graphs and just discussions. So let's see how that turns out. Okay, so to start off, we will see. Let me just see. Okay, cool. So at a company level, like you have the CEO, the boards, everything. And one major thing back in the day was that people used to spend time on things that, well, they shouldn't be spending time on. And well, that in itself can be a risk. You lose more time, and if your operations, especially if you're, as Kevin just presented, if you're a manufacturing operation, then you're pretty much working on a time frame, and you're very time sensitive in your operations. So there was this guy back in the day, I think in the 1920s, he posted this called Frank Knight, and he defined, like after a while, after a lot of philosophical discussions, the difference between risk and uncertainty. And this was essentially the point at which he got the people in charge of deciding whether or not, like, what to spend time on, to say, okay, risk is something different from uncertainty. And we have to, and one of the main things in our operations and our outlook on the future is to discern which is which. Because once you can do that, then you can focus on your attention on things that needs the attention. So night, it's often viewed as nighty and uncertainty. And he said that uncertainty is pretty much things that might happen, but you can't evaluate. So that can translate into different philosophical talks on probability and whatnot, but that is for another time. So this is what he meant by uncertainty. And just as you might derive from the previous talk there, risk is something that might happen, and you're able to gather data to evaluate the likelihood of it. So this was like a major breakthrough back in the day because, like I said, it allowed people to focus on things that needed to be focused on rather than just dwelling on things that they have no control over, or they think that this might happen, and then they spend like too much time trying to figure out ways to evaluate how it will happen and evaluate the impact of the occurrence. So this led to a very practical definition of risk that people use to evaluate the operations. And simply put, it is the probability of an adverse event, occurring multiplied by the impact of the event, which is pretty straightforward. You have two separate things here, and you just multiply in the product of both quantities. And this simple definition is used pretty much throughout industry, regardless of whatever risk you're going to be evaluating. So before I get into the type of risk we're going to be focusing on, which is financial risk, I just saying, like, just to augment what I just talked about, this is pretty much the process on which a company goes through their evaluation. The key points here would be the risk appetite. This will be the the big guys in the company, the CEO, the CFOs, the CROs, the actuaries, all of those people, along with the major stakeholders, all agreeing on how much risk we can take on for this coming year or this coming quarter, or whatever. Okay, so that's your risk appetite. And this in itself is a very arduous process. It has to be very precise, and it's not something that is a one-off thing, because as you see, you have all these arrows going back towards the starting point. So it's like a cycle, you can see. The risk appetite is formed, and then it is pushed to the different divisions, the business units, and all of them, you will have your risk analysts working at the different business unit level to pretty much take what is written in your risk appetite, evaluate, see how likely everything is, and then you will push it back to the upstairs management to show them the numbers behind it, basically. Because up until that point, everything is subjective. That is pretty much what all the CEOs does. It's like, I don't know if you guys ever saw the movie Margin Call, but there was a famous line in the movie. The CEO said, he makes the big bucks just to sit down in the chair and guess what's going to happen. He doesn't really do anything. So everything here is subjective. The objectivity comes in here and it's pushed back to here to reevaluate and assess. So this is a nutshell. Everything here is a more detailed process, obviously, but this is a nutshell of the overview process. So we're going to focus on financial risk. And financial risk has a simple definition. It is the risk of losing money in an investment or business venture. Right? That is pretty much what I expect from the name. Um, so there are different ways of breaking up financial risk, and the main categories, you can see the big three: credit risk, which is risk, I guess you can say, occurring from default. You lend money to somebody or you lend money to an organization, and you want to evaluate the likelihood of them defaulting, which is pretty much the main punchline of credit risk. But this can also be split up into smaller categories, namely counterparty risk and liquidity risk. And then you have market risk, which is the big one, which is things that you have pretty much no control over. You cannot really diversify away market risk. It's something that is in the system. So another name for market risk is systematic risk. And these are things that would be like, let's see, interest rates, changes in interest rate, changes in foreign exchange, geopolitical risk. You have fiscal policy, monetary policy, government policies. All of these things would invariably come back to market risk. So you have to find some ways of catering for all of these things. And then you have operational risk, which is pretty much what you incur simply by owning a business, right? So you have poor management decisions, you have poor evaluation of services, you have poor what do you call it, decisions being made at the board level. So all of these things here are important to realize and to assess. And all of these things, like I said, are assessed mainly at the risk appetite level. And then they go into the business units and they are evaluated and then pushed back to the business level, to the management level for evaluation. Okay, but all of these things here are also interconnected, so they are not mutually exclusive. Okay, so how are we going to minimize all of these things here? Well, we're just going to hedge it. Hedging is a way of offsetting the financial risk. And there are mainly two. So the main definition of hedging is you're going to offset the losses in investments by taking opposite positions in a related asset. Now, this is related to financial risk, namely investment risk. Okay, so you have some investment, and that investment has a probability of incurring a loss, and you want to minimize that loss somehow. So you're going to, as the definition says, if you are invested in a position A, you're going to take a position opposite to position A somehow, and that will hopefully minimize the occurrence of a loss. So you can argue that there are two ways of hedging. There's something called natural hedging, and then there's hedging by derivatives, right? So natural hedging is simply you're going to um, you're going to try and hedge in your normal business operations. So as the definition says, the management strategy that seeks to mitigate risks by investing in assets whose performances are inherently negatively correlated. So that's kind of a mouthful. So let's take some examples. So let's say we have a portfolio of stocks. You know that all stocks are not going to move the same way, right? So if you're investing in a portfolio of, let's say, 50% stocks that move with the market, that you want to hedge that 50% move by investing in stocks that are negatively correlated with those. Okay, so your losses in some would offset the gains in the others, and you would hope that the gains would outperform the losses. So that's an example of hedging with equities. You also have exchange risk. So if you're a company that incurs costs in a foreign currency, then you're subjected to exchange risk, for foreign exchange risk. So one way of hedging this is by continuing with your regular business operations, but you try and incur costs in your you can say local currency, or home currency is the technical term you can say. Okay, so that means that all of your costs and your profits will be in the same realm of uh, geopolitical risk and market risk. Okay, and you have this one called bond investing. So bond investing is like one of the safest ways of investments. So going back to equity, another way of hedging an all equity portfolio or hedging stock investments would be to invest in a bond, because we all know that when the market does bad, stocks tend to do bad because companies will be producing less and less output. But a bond is a way to go against that, because a bond is generally safe during times of volatility, you know, and that is a way of natural hedge. And it can also be thought of as a way of hedging with another instrument. Now, natural hedging is simple, and it doesn't really deviate too much by adding any additional sources of risk. But it can be kind of ineffective, because you're not really diversifying your holdings or your portfolio. So enter these things called derivatives. And derivatives are simply assets, okay? But uh, more so, they are contracts. So let's see a proper definition of derivatives, okay? So a derivative is a contract between two or more parties whose the value of the contract, is based upon an agreed underlying asset or group of assets. So that's where your name derivatives come from. The contract or the asset doesn't have a fixed value. Its value fluctuates throughout, right? And because it fluctuates throughout because it is based on the underlying asset, right? So you will see some examples right here. We have forwards, we have futures, swaps, and options. We're going to take a close look at options in the coming slides, but you can argue that these four derivatives are four of the major ones, the most traded ones you can see. Um, and I guess I can give an example of what a forward is. So a forward is a contract, right? And it's pretty much a contract that locks in a price now, so that you can use it later on in the date. So for example, forwards are originally used in the commodity markets. So let's say you were a farmer, right? And you are worried that in the coming months you're going to have some adverse weather, and that's going to diminish your output. And as a result, you won't be able to sell as you won't be able to buy your supplies as cheap as you would want it to. So let's say you want to buy some supplies for your farm. What you can do is you can enter into a forward contract with your supplier, and you can say, okay, so in a year's time, which is the time frame you want to look at when you think that the adverse weather is going to come in. You say that, okay, in a year's time, I am going to buy your product at a price that we are agreeing upon right now. So no matter what the price is in the future, we are agreeing to transact at this price here that we are agreeing upon now. So that is a way of hedging for an increase in price of our underlying assets. Okay, so you can see that the price of the forward, the value of the forward, my bad, will be dependent upon the underlying assets, whether you make a loss or a profit, because no matter what, you have to um, you have to facilitate your end of the bargain. You have to facilitate by buying that product at the end of the 1 year, no matter what the price is. So you have a possibility of making a loss and or profit. Okay. Um, so in addition, and I guess I should mention this also, in addition to hedging, you can also trade options as an actual investment, and people tend to do this using speculative trading. And I'll get a bit into this on the next slide when I believe I have some advantages of using derivatives for hedging. So, well, obviously, the first one, you get to hedge financial risk. Okay, that's self-explanatory. You have the pricing of the underlying assets. So, in some cases, mainly in the commodity markets, if you can correctly price the value of the derivative, you can use that as an approximation to price the underlying assets, which gives you another layer of certainty. And you can use that in addition for different calculations. Because sometimes it's not always used to price the underlying asset for different reasons. But the derivative, because of how it's laid out and how the payoff structure is presented, it can present an alternative and easier option to price the asset. Market efficiency. So because of the fact that you have you can trade derivatives, you can get the market to be a bit more imbalanced, right? So you can do something, but you can prevent arbitrage opportunities. And arbitrage is pretty much a way of making a risk-free profit without any effort at all. Okay, so and you have access to unavailable markets. So so if you go back to the last slide, keeping in mind the last point, access to unavailable markets, you have something called swaps. So swap is an example of that last point. So you can use swaps, specifically interest rate swaps, to get access to different levels of borrowing at different interest rates. So for instance, if for example, you incur costs at a fixed interest rate, you can enter into a swap with a different party in order for the fact that you can gain access to a variable interest rate. So what that means is that the other party will pretty much pay your obligation, but you have to pay them interest rate based on an interest rate that is fluctuating, not fixed. So that can sometimes be bad or good. If it's fluctuating, it can be above the fixed interest rate or it can be below it. So that is also a risk you're taking. And that leads me into the next section of disadvantages. Well, you have high risk because nothing is free in this world, especially in the realm of finance. Everything is pretty much a probabilistic event. Um, so you have, as I just mentioned, if you're entering into a derivative, you have the occurrence of high risk because they are very volatile instruments, and they could be very sophisticated in terms of what are the agreements, because people can actually speculate with these things. It can cause a lot of damage. In fact, Warren Buffett has been known to say on record that he hates derivatives. I think he called them financial weapons of mass destruction, because derivatives were pretty much, well, one of the derivatives, specifically a credit one, something called credit default swaps, was a major part in the 2008 financial crisis. I think it was like 99% responsible for the downfall of AIG, which was one of the biggest insurance companies in the world. And because of speculation, credit default swaps, people who had no business in investing in AIG and doing business with them, they were allowed access to the market, by this point here. So that was a proof for them. But when the market started to go south, everything, because they were just speculating on how the crisis would go. AIG in turn had to pay out tons of money because of the credit default swap, and they just end up going bust. So that is allowing access to unavailable markets and going goes hand in hand with speculation. It depends on how you use it. And this here difficult to price goes back to the first point with high risk, because these derivatives can be so sophisticated and tailored to specific needs. It can also be difficult to price, and that can be seen in an example again related to the financial crisis of 2008, something called securitization. And this has something to do with people forming derivative contracts and assets based on mortgage-backed securities. But these things were like so sophisticated in terms of how they were layered and how their payoffs were structured, that quite frankly the analysts couldn't price them. And when they saw their losses, it was pretty much unheard of. So yeah, derivatives can also be, as Warren Buffett said, weapons of mass destruction. So you have to be really careful with them. You know. So that is pretty much an introduction to what derivatives are. So we can go into options. Options are arguably one of the most popular forms of derivatives. And we're going to start off with what is an option. Okay. So an option is a financial derivative which gives the buyer the right, notice I highlighted the word right here, but not obligation to buy or sell the underlying financial asset at an agreed upon price and date. Okay. So taking apart that, so if I buy an option, okay, I have access to the underlying asset based on some pre-existing conditions. And we're going to see what those conditions are, because options are mainly defined by some quantities. And we're going to see here that the first quantity is called S. This is namely the price of the underlying assets. Okay. So for example, in terms of an equity or a stock, we can say S represents the current price of an Apple share, which I think at the time of making this presentation was $132 per share. Okay, so that's S. And we have a quantity called K, which is called a strike price. And K is the agreed upon price of the contract. So no matter what the price of S is, if I choose to exercise the option contract at the time of maturity, I am able to, let's say, buy or sell the option at the agreed upon price K. Okay, so we can see automatically how this presents itself for a hedging strategy. All right. Okay, so now there are many different types of options, and I think I didn't put this in the presentation, but we're going to mainly be talking about European options here. And European options simply means that you can only exercise your contract at maturity, so at time T. The other main one is something called an American option. And an American option simply means that you can exercise it at any time throughout the period of the option contract. Okay, so it doesn't have to be a time T. If you see that the price is moving in your favor, you can choose to exercise your contract then. Okay, that has the advantage over European contract, which is limited to maturity, but it also has a disadvantage in which it adds an extra layer of uncertainty and pricing. And those are called vanilla options, European and American, because they are the most common ones. There are also things called exotic options. And as the name implies, the payoff structures and how they are layered are a bit more, well, exotic. You know, they're a bit more specific to what you need. So two examples of that are something called a Bermudan option, and then there's something called an Asian barrier option. And all of those things are pretty much the same. They have the same definition here, right, as the first thing here. But all of these things would be slightly different. Okay. Now, like I said, we're going to be focusing on European options here. So let's look at the two types of it. We have call options and put options. All right. So we're going to look at each of these don't worry, they're pretty much mirror opposites of each other. So if you know one, you can kind of guess what the other one is going to do. Okay, so we have call options, and call options, right, simply gives the buyer, the long party, the right to purchase the underlying asset at a predetermined price at maturity, again, European options, from the seller of the option. Okay, so if I buy an option, if I buy a call option for, let's go after the, let's use the previous example. If I buy a call option on Apple stock, right? And Apple stock is, let's say, trading at $132 right now, and I buy a call option for with a strike price of $132 for, let's say, a maturity of 1 year. Then if Apple goes up during that time, the price goes up, then I have the option of using my contract to buy Apple at $132, right? But it has to be during the year. And the person who sells me the option, the short party, is obligated, if I exercise it, to sell me that stock at the predetermined price. Okay, so that's a call option. A put option, as I just stated earlier, is the mirror opposite of it. Okay, so if I buy a put option, then I have the right to sell the underlying asset at a predetermined price. And whoever sells me the put option will have the obligation to buy that asset from me at the strike price. Okay, so we can see, you can see one time what a buyer of a call and a buyer of a put wants to happen, right? The buyer of a call wants the price to go up, and especially wants it to go up above the strike price. The buyer of a put has the wants the price to go down. Okay, so all of these things are hedging in the sense that you have a certain outlook on the markets and you're buying these things now to hedge the future risk of it. All right. Now, let's see some payoffs, some diagrams here finally in terms of some. So we have a simple equation. We have the payoff of the call, right? Let's say we exercise the call option, right? The call option will be exercised if the price at maturity, we have S underscore, we have S subscript T, the time at maturity, is greater than the strike price, right? This will be positive. We want to be positive. We want the price to go above K, right? Otherwise, we wouldn't exercise the option. And we can see how it looks here from both points of view. We have the long party, and we see that as the price increases, this here would be the strike price because it crosses the x-axis at 0, right? Sorry, at this point here, and this is where the payoff equation would be 0. And you can see above the strike price, the payoff is positive, which relates to this equation, right? Below the strike price, you're at a loss because, I didn't mention this in the previous slides, but you can't enter a contract for free. You can't enter an option contract for free, sorry. You have to pay some kind of premium, right? So that is essentially the risk, one of the main risks of not exercising the option contract, but probably the only risk. You're going to be out the premium, right? But you can see that the premium, the loss will be offset the higher the price goes, especially above K, right? This is from a long point of view, by the way. This we can look the mirror opposite of a short point of view. The person who sold you the option contract, a call option, they want the price to go down because at the inception, you pay them a premium. So this is their profit here, but their profit will slowly go down as the price increases. It crosses K, right? And their profit starts to minimize. So that is diagrammatically how it looks. We can look at the put option, which is pretty much, like I said, the same exact thing, just flipped. And like, remember the put option, the whole of a put option, the buyer wants the price to go down. So you just reverse the signs and you just add the two things together, because your profits as a buyer of a put option will only be apparent when the underlying stock price is lower than the strike price. You can see here, this is K, and you can see the profit is positive here for this portion of the graph. And again, you will be out the premium here. This is what you put up at the start of the contract. And this is from a long point of view, and this is from a short point of view. And you can see it's pretty much mirror opposites of the call payoff diagrams because of how the payoffs are structured. Oh, I spelled both wrong here. Sorry. Um, so that is pretty much how both basic contracts work. Like I said, we're going to show you three simple strategies as you know how you can use this in practice. The first one is called a bull spread, and it's called a bull spread is because you have the outlook that the prices of underlying stock is going to go up. So again, using Apple as the example, for some time in the future, you think that Apple price is going to go up. So what you can do is you can construct a bull spread, which includes you're going to buy a call option with strike price K, and you're going to write a call option, or you're going to sell somebody a call option with strike price K1, such that K is less than K1. And you can see why, in the sense that as long as the the price is going up, you have this profit here, and then your profit is pretty much plateaued, let's say at K1, if the price goes up past K1. But if the price doesn't go anywhere, well, you pretty much break even because you buy a call option, so you pay a premium, and you also write a call option, so you receive a premium, and that's why you have this short area under the graph right here. Sorry, not short, small area under the graph, because you don't want to write these two with the strike prices that far off, because these things can affect how you price the options. So you can see that in the event that the price goes up, you can make a profit between K and K1. And the profit will be maximized if the price goes above K1 here. So that is an option to mitigate against rising prices. And you can also do the same with a bear spread with put options. And it's the same logic, but this time it's kind of flipped. So instead of buying the option with the lower strike price, you're going to write it. You're going to sell somebody it. And instead of selling somebody the option with the higher strike price, they're going to buy it. Why? Because simply you want the prices to go down. And that is the lower the price goes, the bigger profits you make. Okay. And again, your profits will be plateaued right here. So that is what these two simple strategies look like. And you also have this one called a straddle. And a straddle is a strategy you can enter into if you have an idea that the market is going to change, but you're not too exactly sure what direction. Okay, so you just know it's going to change by a certain amount and a time frame. So what you're going to do is simply you're going to buy a call and you're going to buy a put. So no matter what happens, or at the same strike price, sorry. So no matter what happens, you can make some kind of profit. The the price just cannot go lower than K. It has to stay like in this region right here. Okay, so you can see how the payoff diagram works. And this is where you kind of break even, or this is where you have the majority of your losses at the premium level right here. Okay, because your premium will be double because you're buying two options. So that is three examples of simple strategies that you can enter into. Now, to finish off, I'm not going to talk about these. I'm just going to show you the next step in option trading. All of these things here are well and good in terms of you have an idea of where your market is going to go, but you also have to price the option. And these equations here are those famous things called the Black-Scholes equations, which I think the guys who came up with it won Nobel Prizes. And these are, you can think of the go-to models to model option prices. Okay, so the Black-Scholes framework I bolded out this one because it is the most used one in industry. And it is pretty much an extension of the risk neutral pricing, which kind of prices options in discrete time spaces. But the Black-Scholes framework takes this model and translates it into continuous time frame. So you have to, use a bit of stochastic calculus and things to understand it. But this is pretty much how it looks. So you price in the call option here. The value of it is equal to the S, which is the price of the underlying asset, by the standard normal distribution evaluated at D1 minus K, which is the strike price agreed upon. You have the interest rate, which is usually the risk-free interest rate at the time. You have the period, which is the time to maturity and the time at which the option is written, and you have another standard normal distribution evaluated at D2. And you have these quantities here for D1 and D2. All of these things here has interpretations, but I won't go into those things here because it can be a bit convoluted. Um, and like normal, the put option is pretty much the opposite of it. So you just kind of negate everything, and you get this equation for the value of the put option. So this is just one way of pricing these options here. But all of the risk experts kind of agree that yeah, this is what I'm good, right? You have to price it correctly, but you also have to kind of, if you especially if you're going to have a portfolio of options, you have to go risk management on these things here. And in order to do that, you have to consider these things here called the Greeks. And I guess the name of the Greeks because Greeks are pretty much inherent in mathematics. The Greek alphabet just looks like mathematical stuff. And all of these things here are pretty much partial differential equations based mainly on these equations. So as you can see, the value of the option depends on S, the underlying price. It depends on the interest rate. It depends on the strike price. It depends on the time to maturity. All of the and these quantities here, D1 and D2, depend on those quantities, but it also depends on the volatility of the underlying process. Okay, so all of these things here can be translated into the Greeks, and the Greeks are simply partial PDs based on those quantities. So the delta, to give you an example, is the price of the option, how it varies based on the underlying asset price. So how are the options varying based on how the underlying price process? The gamma is the variation of the delta of the option. The vega is how the price of the option varies with respect to volatility. The theta is the price of the option with respect to the time or the period it measures time decay. And the rho will be the price of the option with respect to changes in interest rates. And to give an example, this is how they look like. So you can see based on these things here, depending on what is the underlying assets and depends on like what the company is exposed to, it will mainly decide which quantity you want to focus on. Mainly people will focus on deltas and gammas, but you can say that if your company is more volatile, you will focus on more vega. Or if your quantity has a lot of political exposure, you'll be focused more on market risk, which is basically interest rates. So you'll focus more on rho. So a lot of these, and by the way, these are the main Greeks, but there are a lot of other smaller ones that stem from different option models. And this here can give you, and it goes back to the disadvantage of being able to price derivatives and the high risk and the volatility involved. So while it gives like a very nice, specific, bespoke way of hedging risk, it can also be a very, very big double-sided sword. And with that said, I think I talked about everything I wanted to talk about. It is a pretty basic introduction with obviously room to grow because I introduced all of these things here. But to understand these things here, you have to have an understanding of Levi processes, Ito calculus, which by extension comes from stochastic calculus and whatnot. And that can take up a bunch of time. So with that being said, I think that's it. Any questions?
Nice presentation, Nishad. So I guess a lot of this has to do with estimating parameters, right? And as we talk about all the filtering and stuff like that, that's where that would come in.
Yeah. So, for example, to go back to volatility, um, how volatility is usually measured is by interpolation in the sense that you use historical prices to create something called volatility smile, which is really just volatilities for different option prices. And they usually use that curve and to kind of infer the volatility for the underlying process. So it's not really like very hardcore things because of the fact that you have to kind of optimize all of these things here. And the fact that volatility is, even though we have good models for it, it's still not that accurately measured. It's more observed than measured. So it's a trade-off, as you might expect.
Right. Plus, it's non-stationary, right? So
Yeah, exactly. And actually, I should have mentioned this too. Thanks, Prof. One of the main assumptions of the Black-Scholes model, even though, like I said, this is still one of the main models used in industry, it comes with a lot of assumptions, and I I believe that over 50% of these assumptions are violated in practice. Because off the top of my head right now, it assumes, as Prof just asked, it assumes that volatility is constant. And one time you know that that is not true. It also assumes that interest rate is constant, which is not true. And it also assumes that prices tend to follow something called a log normal distribution, which stems from a Levi process of a Brownian motion, which is that can be acceptable depending on what the time series looks like. But prices tend to well returns tend to follow something called a T distribution, which is more heavy tail. But log normal is good because it allows for this convenient way of representing the prices of the options. But that gives you an example of the assumptions that are violated by this model, but yet it's still pretty much used in practice, if that answers your question.
yeah. Okay. Thanks.